G'day and welcome to the CoinCobber YouTube channel. Today we're going to tackle a big one, corporate hedging. Now I know, it sounds a bit complicated, but stick with me, will you? You'll see it's basically just a financial seatbelt for a business.
All right, let's have a quick squiz at what's on the menu for this explainer. We're going to start with the main idea of hedging as a type of insurance. Then we'll look at the different players in this game. After that, we'll break down the tools they use, things like futures, forwards, and options. And we'll wrap it all up with the big why. Why these massive companies choose being certain over chasing a massive payday.
So, to kick things off, let's think about a real-world problem. Imagine you're running an airline, right? Your biggest cost by a country mile is jet fuel. 1 minute the price is fair income, the next it's gone completely troppo. So how on earth do you set your ticket prices and make a proper budget when your main expense is all over the shop? Well, this is exactly the kind of problem hedging is designed to solve.
And that brings us perfectly to our first section, which is all about the big idea behind hedging. Look, it's not about trying to hit the jackpot, it's about making dead sure you don't go broke.
So, what is it really? Well, at its core, corporate hedging is a defensive play. It's a strategy that companies use to shield themselves from those wild, unpredictable swings in the market. The whole goal is to neutralize risk in their day-to-day business, not to make some massive speculative profit. Honestly, this is the absolute best way to think about it. It's just like how you buy car insurance in case you have a prang. A company uses hedging as financial insurance. It's there to protect the business if the market suddenly crashes or a price suddenly skyrockets. Simple as that.
Okay, let's get into the two main types of players in this game. Now, they both use the same financial tools, but believe me, their mindsets are absolute chalk and cheese. So, on one side, you've got your hedgers. These are your big companies, right? Your airlines locking in fuel costs, your farmers trying to guarantee a price for their wheat. They absolutely hate risk, and all they're looking for is a bit of stability. And then on the other side, you have the speculators. These folks, they love risk. They thrive on things being all over the place, and they're just trying to make a quick buck by betting on which way the market's going to jump.
And you can really see the key differences laid out here. A hedger's motivation is purely defensive. It's all about protecting the business. A speculator? Nah, they're on the attack, making an aggressive bet. But the most telling part is that last row. See, a hedger knows their maximum loss is limited. A speculator, though? They could lose their shirt and a whole lot more.
And this really sums it up perfectly. If the financial market was a car, the hedger is the one making damn sure the seatbelts and airbags are working. The speculator? They're the ones strapping a massive turbocharger to the engine, hoping for a massive burst of speed, but risking the whole thing blowing up in their face.
Right then, let's get into the actual tools of the trade, starting with contracts that really lock you in. These are binding agreements to buy or sell something down the track for a price that you agree on today. Now, these two sound pretty similar, but they're fundamentally different. A forward contract is basically like a private handshake deal between two parties, say an airline and a bank. It's totally customized. A futures contract, on the other hand, that's a standardized public agreement that's traded on a formal exchange, like the ASX.
The really big takeaway here is something called counterparty risk. With a private forward contract, there's always a risk that the other mob will go bust and won't be able to honor the deal. But with a future, the exchange itself guarantees the contract. It acts as the middleman, and to do that, it makes you put down a deposit, a margin, and it settles accounts every single day. This just makes it far, far safer.
Okay, let's move on to a different type of tool, one that's a bit more flexible. These are called options, and they give the person buying them a really powerful choice.
So first up is a call option. This gives you the right, but, and this is the important bit, not the obligation to buy something at a price you've already agreed on. You'd buy a call if you reckon the price of something, like a stock or a commodity, is about to go up. It's what we call a bullish bet. So let's break that down, yeah? The buyer pays a small fee, which is called a premium, just for this right. Now, if the price skyrockets, they can use their option and buy at that lower locked-in price. Beauty! But if the price drops, well, they just let the option expire and they only lose the small premium they paid. So their risk is capped, but their potential profit could be huge. Now, on the flip side of that, you've got a put option. This gives you the right, but again, not the obligation, to sell an asset at a pre-agreed price. This is a bearish move. You'd buy a put if you're worried the price is about to fall through the floor. Now this is a classic hedging tool. Imagine you own a whole bunch of BHP shares, but you're getting a bit worried about a market downturn. Or maybe you're a gold miner and you want to lock in a minimum price. You can buy a put option. If the market tanks, your option lets you sell your asset at that higher, pre-agreed price, protecting you from the loss. It's your insurance policy against a nasty crash.
So after all that, what's the whole point of this for a big company? I mean, why would they go to all this trouble?
The crucial point here is that it's all about planning and certainty. That airline we talked about, it needs to know its fuel costs for the next 6 months so it can set ticket prices and create a budget that actually means something. By hedging, they deliberately give up the chance of a massive windfall if fuel prices crash, but in exchange, they get the priceless ability to sleep at night knowing their biggest cost is locked in.
And really, this is the question every business has to answer for itself, isn't it? In a world that just seems to get more volatile by the day, is the certainty that you get from hedging worth more than the lottery ticket of a massive, speculative payday? For most big companies, the answer to that is a resounding yes.
And that's a wrap on this explainer, folks. If it cleared a few things up for you, do us a favor and chuck us a like. It really helps the channel out and lets us know we're on the right track.
And hey, make sure you subscribe to the CoinCobber channel so you don't miss our next deep dive into the nuts and bolts of the financial world. Cheers, and we'll see you in the next one.